All right. Welcome, first responders and first responder family members, to our 5-day Wealth Op Challenge. Today is day 3, Thursday, July 13th, going through the days. And today is all about better, best. Wow. Good, better, best. Oh my goodness. Good, better, best. I'm so used to having my slides in front of me. Totally messed that up. But today is all about good, better, best. I'm excited to hear from Ramie today. How many of you guys have been really enjoying the content and wisdom from Michael and Ramie? I know I am. I've been over here taking notes because, man, this stuff is. Oh, it's so good. It's helping me grow and develop as well. And this is stuff that I really want to know because yes, Michael knows it and understands it, but God forbid one day he does not come home. I still have to run our family, our legacy, the wealth that we've created for our son and hopefully his grandkids, or our grandkids, his kids. And so it is something that I have a passion to learn as well, because I really believe in the content that we're teaching you guys. I believe that it's life-changing content. So I'm really excited to dive in for day 3 today. But before we do that, I have a little special guest who I want to introduce you guys to. He has been really excited all week long to come and say hi. This is our son, Micah Jude. Do you want to say anything?
No, I'm good.
No, you're good? Okay. So this is Micah Jude, and he is very well aware of the legacy that we are wanting to build and create, not just to hand it to him, but to help train him up to be a value provider as well. And from the sense of, you're almost there, don't push it. From the sense of showing up to solve problems and add value. As first responders, you guys know every single call you go to, you are adding value, you are solving problems. And so we're just going to continue to show up and help you guys learn how to do that in all areas of your life. And you guys, believe it or not, are already very skilled in that way. Right now, it might be, stopping a bleed or assessing a crash, but we're going to help you guys do the same thing for your wealth. I'm excited as we continue on through this challenge, what is to come for you guys as you are learning more. So let me go ahead and share my screen really quick with you guys. And I want to go through, as you guys know, this is day 3 in the Wealth Op Challenge. And yet today we are doing good, better, best. We're going to be talking about the best path to retirement and how you can ensure that you're on that path. You're going to hear about the benefits and problems regarding real estate and how you can play the game. You're going to learn about the most unique industry to leverage for wealth creation, as well as secrets that most people don't know. This is one of my favorite conversations Ramie has about risk management. You guys are going to love it. And you're also going to learn about an investment that is the best to create short-term, yes, and long term, because long term is great, but it's amazing to have short term wealth creation options as well. Yesterday, we had some content, and so I actually want Michael to come in really quick. Most of you guys know this guy. He is, yeah, let me see. I actually might need to change our view real quick. But he's going to do a quick little debrief for you. For those maybe who don't know him, this is my husband, Michael. Most of you do know him, chief financial officer to police officer and the first responder. This course, this challenge is created by first responders. This guy for first responders, and he has some experience in fire, EMT, police as well. So, babe, if you would debrief us on yesterday's. Oh, I might have him out of order. Oh, I skipped a slide.
It's all good.
Oh no. But the slide that I skipped, I feel like is important. It's the definition of leverage. And let me show you. Let me take, oh, sorry.
You're good.
I skipped a slide and now it threw me off. But this is a good opportunity to show you guys what I built for you. You're going to get this in your replay email. It is the Wealth Op Challenge workbook. So you guys will get this, and you'll notice on here that we have some fun little fill in the blanks. But leverage is the ability, I believe, to access more wealth, yeah, with less effort and capital. See, I am starting to learn and pay attention. But you guys will be getting this workbook, so pay attention for that. That way, you guys can have a place to take notes. So be on the lookout for that. That was our day one debrief. But I'm sorry, our day two debrief. Slide one, I missed it. So here's day two debrief, slide two, and Michael's gonna cover that. That's
Perfect.
why we're a good team.
Absolutely. All right. So, hey, thanks for joining us. If you're on the live feed, thank you for being here. This is day 3. And if you are watching the replay, thank you as well. We do have a comment section. If you've got questions or comments, please let us know. It's been fun. My phone has been going off the hook, which is exciting. I think we've got like 6 or 7 agencies represented here, which is awesome. The message is getting out there. And just if you weren't on day 1 or day 2, watch the replay for sure. But just kind of an idea of what we're doing. I've got 15 plus years of financial experience, Ramie as well. And our goal when we started or went to this industry is like, hey, I want to help first responders. Yeah, the altruistic approach. I want to help people, which is great. But when I got here, that I found a desperate need for first responders regarding wealth creation, building things like generational wealth. And if you're not familiar with that term or that's new, it's how do we create wealth that's going to outlast our generation, play the tax game right, pass it on correctly. The third phase of your wealth cycle in life. How do we create this generational wealth for people? So all these conversations I've had with first responders of, hey, I can't get out of debt, or hey, how do I leave wealth for my family, or hey, how do I buy a house? How can I do something beyond just my pension? Probably 1,000+ conversations have been had between myself and other departments that I talk to, guys and girls, my department, conversations where people are literally breaking down in tears. Like, I can't get out of this overtime game. I'm so stuck here. What do I do? And so we basically decided, myself and Ramie and Holli and his wife, Shelly, like, how do we help first responders? Well, why don't we create a wealth training system or a systematic approach on how to build wealth? Because it's not just one thing. It's not just going to buy a rental house. It's not just going and buying a life insurance policy. It's not just understanding the stock market. It's not just buying a commercial storage facility, having a living will, having a revocable trust, all these things that are part of the wealth game, but it's not just those any one individually. So we created what's called the Wealth Op, and the idea being it's an operation plan to create wealth for your family. Generational wealth, like we talked about, leaving a real legacy. I mean, our belief is very simple. We have a duty to succeed and do well by our family. And so if we're going to really create something that's worth handing down to our kids, not only do we have to teach them to be ready for it, but how do we hand it down in a way that they're set up for success? I'm not trying to leave my son with a massive tax bill. I'm not trying to have him stuck in probate. I'm not trying to have him have all this money and not be prepared or have the skill set to use it, or all this wealth of these businesses. So the idea behind the Wealth Op is, let's put all of these pieces in place in the right order to actually help somebody create wealth quickly. And if you do the math and you do these steps in the right way, the idea is simple. How to retire in 10 years or less. So if you decide to walk away from this career, or maybe you can't physically do the career anymore, you can either say, raise a certain finger towards a job if you need to, or you can simply say, hey, I've done what I can. I've helped people, I've served. It's time for me to actually walk off into the sunset. And the idea being also, if I'm in retirement, how do I have enough wealth and enough income that I can live the life that I want to live without the fear of running out of money? So it's kind of a quick backstory. I know this is day 3, but I think it's important to refresh. And then we can look
and
at
there's
really
another
quick.
one that you forgot
Oh,
in
yes,
there.
tell me.
It's like, Michael, you get to have both. And Ramie talked about that yesterday. Let's say you want to create this wealth plan too, that you could retire in 10 years or less, but you still love the job so much. It's your dream childhood career.
It is a lot of fun.
And you get to do both. And so we're just creating options for you guys to understand kind of where you are. So back to our day 2 debrief really quick. I thank you for that re-intro. I know
Sure.
we had a few new people join yesterday. So day 2 yesterday, we talked about time.
Yep, we talked about time.
Trading time for money.
Trading time for money. The problem with trading time for money is time is a limited asset. They say it's the most limited because you cannot create more time. So creating time for money, there's nothing wrong with that. But while we're creating time for money, let's use other skill sets and other wealth vehicles. And those are simply, back to the definitions, a vehicle that's going to create wealth. So whether that's a commodities, whether you're options trading, et cetera, whether you're trading paper assets, you've got life insurance products, you've got other paper type assets, you've got real estate. There's all these different wealth vehicles. So the idea being, if we're going to trade time for money and do what you love to do, how do we utilize other wealth vehicles at the same time? And the idea being, if we can leverage those vehicles, we can still work and we can still do what we love to do, but we've got other things that are feeding not only our wealth plan, but actually are creating money and creating cash and allowing us to really do what we want to do with a level of freedom. Because back again, I keep going back to this. If we can help remove some of the stressors in your life, whether it's a debt situation or you're having a hard time just making monthly bills, the goal of this is simple. If we can remove some of the stressors, hopefully marriages are healthier, parents get to spend more time with their kids, you show up better at home, which means you show up better at work, so you get to help more people. So time for money is great if you are also utilizing the right wealth vehicles and leveraging. Passive versus active investing. This is a pretty big topic for me. We talk about it in my department a lot. And obviously, if you don't work with me, you're not maybe familiar with this term. But the idea being that we're going to actively take a approach and a tactical mindset towards our investment future and our wealth plan. We're not just going to let it sit by. We're not just going to put money in deferred comp or your 457B or maybe your spouse's 401k and let that grow at some target retirement fund that really doesn't have your specific family in mind. And we're actually going to engage and say, hey, this is what I want to build. This is what I want to do. And I'm going to actively take a role in my retirement. There's different ways to do that, especially when it comes to things like deferred comp or other investment platforms, but even your pension. A lot of people aren't aware that when you get close to retirement, there's a decision day that you have to make. It's basically one of three options. And if you choose the wrong option, there is no, do not pass go or do not restart. You are simply stuck with that option. So if we're going to take an active approach in our retirement, you cannot be not present for that day when you're choosing what option to select and how you're going to retire with your pension, especially here in California. It's both and. So it's both and not this or that. So this is the idea that if we're doing this right, we're going to create an and approach to our life. So we're going to show up and trade time for money. That's fine. We're going to take an active investor, an active role in our investment accounts and our retirement accounts, but we're also going to build skill sets. We're going to try to deepen our knowledge base, and we're going to create different streams of income. So all of those can be working at the same time. And so now it's this and that is working for us, not just this or that. And then the big one too, which some of you may not be aware of this, but your pension's under someone else's control. We just had, if you're in the PERS system, so if you're watching this, you're in California, and I forget it was 2012 or 2013, CalPERS enacted a new system. It's a PEPR plan, and I won't go into all the details, but the idea being is our retirement is more limited than maybe it used to be. Well, they just enacted a 0.75 increase, which equates to, I think, about an 8% increase in our PERS contribution because they poorly invested in the market and they were utilizing or expecting on good returns from the market to actually fund current retirees. So we just saw a massive increase in our PERS contribution, 6, 7%, 8%, maybe it was like 7 point something, but it was a large percent because they invested poorly. And so I had no control over that. But I was just told, hey, you have to put more money into this retirement contribution because we basically failed. We didn't account for the market's drop, and now we're going to ask for more money. On top of that, I get a retirement, 57 years old if I try to max as far as I can, but I don't keep all that money. I still have a huge bill to pay to the IRS. And if I'm still in California, the Franchise Tax Board, and there's no guarantee what those rates are going to be. So our pension really isn't under our control. Our pension still is a great thing. It still has a great purpose, especially in building out this wealth op. It's a really good thing to have a pension, but we don't want to live under the false premise that I get to ride into the sunset and I don't have a hefty tax bill and or may not be getting what I thought I'd be getting. So that's part of this plan as well.
Good. Which is why it's super important to know what Ramie talked about yesterday, which is the know your number. So we want you guys to know your number, what number you need every month. That number can change, but that way you're not just banking on the pension that, like we just talked about, isn't necessarily fully in your control, but what kinds of things can be fully in your control. So we're going to talk about that today and especially tomorrow. And then day 5, we're going to talk even deeper about risk management. So make sure you guys have those days in your calendar. If you can't be with us live, watch the replay. That's what they're there for. I'm building a replay page for you guys as well, so you'll have access to all of the replays in one spot. But I want you guys to have access to this. That link is there. It's bit.ly/wealthop PFS, which is personal financial statement. And then it'll ask you to just make a copy of it. And then you can fill in your number so that you can know your number. And then
Can I talk about this real
of
quick?
course.
All right, this is raw and we're just running with this. So part of this is, if we're talking about the wealth op, we're talking like an operation plan for your financial success and your freedom into not only retirement, but like we said, generational wealth, etc. Part of this is knowing your number is having the real, raw, honest conversation with yourself, doing a self-assessment, or maybe like a scene size up if you're on the fire side of, let's take a look at my life and where I'm at. Let's do a full size up and let's be real and raw and honest with ourselves where we have gaps or we've got risk or liabilities. And then it's taking the spreadsheet and having the conversation. If you're married, have it with your spouse. If your kids are old enough, have the conversation with your kids of like, here's my numbers. We're not playing this, ominous game of don't know my finances. Well, part of an op plan, if you're going to actually execute an op plan, you have to follow it through. This is one major step. If you don't really know your number and you're not willing to have that conversation, it's pretty darn hard to have the rest of the tools working for you because you don't really have a target to go after.
Yeah.
So this is really, really critical. And maybe the rawest and the most difficult part of actually having that honest conversation with yourself and seeing it on paper, but it has to be done. Just please trust me. Go through the exercise. There's actually a lot of freedom, even if you don't like the number. There's a lot of freedom getting the information out there. So please, from my heart, please make this happen.
Oh, so good. And then lastly, I'll just let you share a little bit on this quote before we bring Ramie on, because I know we're well into day 3. But
so Jerry Rice, some of you may or may not know, quite a famous sports player, Bay Area, but it says, today I will do what others won't, so tomorrow I can do what others can't. This is what this is all about, right? This means I'm willing to put in the work. I'm willing to do what it means to actually take a active strategy in my wealth plan and building generational wealth, building a legacy. But I want to do things right today, so down the road I can really enjoy my retirement. Now, sometimes that means maybe I don't do things that would be more exciting. Maybe I don't, go out and buy the $200,000 car or the $6 million house, or even if we could. But our goal is simply, how do we do what we need to today so we can build a beautiful legacy when we're done with this career, or in less than 10 years and we want to just enjoy time together. So that's really important to me. Jerry Rice fan or not, that's okay. The quote's still good. So anyways.
Awesome. Thanks, man. All right. He'll be back in a little bit, but I'm excited to bring on Ramie for the next part of this session. So as you guys know, if you've been here, Ramie's been dropping major content, truth, revelation for you guys, and he's going to continue to show up that way. So if you guys would help me welcome Ramie Khalil to the Wealth Op Day 3. Ramie, take it away. I don't know if we can hear you. Let me see if we can.
How about now? Hey guys, good afternoon. Well, I'm super excited to be back here on day 3 of the Wealth Op Challenge. And as Mike and Hall said, as they gave you guys a bit of a recap, if you're watching day 3 as your day 1, meaning you just started with us, you just hopped on, you just found out about this, you have the recording. So don't worry about it. You got some context from them on what we've talked about. And really what we've done is we've laid a foundation, guys. We've talked about, the frameworks and really the reason we're all here, and making this shift from being kind of a passive observer and kind of just trying to get through your career and hope that your pension and your 457, your 401k is enough. Instead, taking a more active position and learning how you can use some of the investment strategies that we are about to lay out to retire in 10 years or less. Because time is more important. Quality of life is more important than just the value of an asset. And so we know how valuable your time is, guys. We know what you guys are up to and what you're doing in the day-to-day lives that you have as first responders. And so we don't take it for light or take it for granted that you're here. And I'm excited about this because, as Mike and Hall mentioned, while we've laid a foundation, we've really started to get into what does it take to start actually being on the path to retirement in 10 years or less. And why is that important? Well, it's important because if you can get yourself in a position, guys, where you are not dependent on things you do not control, right? If you're not dependent on having to go to work, assuming you're going to be able to continue to do what you're doing, assuming that your pension and the pension system is going to be able to maintain what, the projection state, if you're in a position where you're not dependent on those things, then guess what? Your career is truly a choice that is separated from your investment and your financial life. It's a choice, but your lifestyle is not dependent on it anymore. So that's really the heart of this. If you love what you do again and you want to continue to do that, fantastic, great. But I always say, one thing I've learned over a decade plus of doing high-level financial planning, when I say high-level financial planning, I just mean being able to sit down with clients who are starting over, from scratch, and clients who have millions and millions of dollars already, have seen all of those different spectrums. And I've done a lot of, advanced level planning for clients with trust, estate plans, and income planning for folks who are just getting ready to transition, guys. And here's one of the things I've learned. When you do not need to do something for money, you really get to test what you say you love, right? You get to test what you say you want to do, that you say you're doing for passion, right? That may get you there, but sometimes, when you have to do something for income, it's very different than when you don't. All of a sudden now you really get to test those things that you're stating that you want to be a part of and you want to do. So we've started to talk about some of this stuff as it relates to strategy, knowing your numbers. I gave you guys homework yesterday. I said, hey, look, what I want you guys to do is to actually go through, fill out the form, right? Make sure that you assess and you can start to think about things from first principles. The goal of investing is to actually get to a place where your assets are able to replace your paycheck. But most people, when they start investing, the assumption is if I just keep putting money away and hopefully the pot grows larger, then one day I should have enough to live off of. And that's a very different mindset than to say, here's the level of income that it takes to maintain my lifestyle today. And so what kind of investment strategies and vehicles are out there that could actually show me how by doing this thing, I would be able to replace my income over a set amount of time. Right? Things take time. They don't have to take as long when you use the traditional wealth formula, which I talked about yesterday visually for you guys, right? They don't have to take as long as you start to actually use what I call the ultimate wealth formula. When you start to look at assets that have leverage, right? Leverage giving you the ability to see results faster. So we've talked about that, guys, and knowing your number is critical, taking an inventory of where you are. But now we kind of have to pick back up on this conversation of once you've done that, assuming you've done that, then we transition into choosing what investment strategy you are going to use to start to actually create and craft and build wealth in. And I'm going to share my screen with you guys, and we're going to talk about a couple things here. One is a brief recap of yesterday, and we started to talk about the 3 asset classes that exist and how you can be passive or active in all 3 of these asset classes, right? There's 3 major asset classes. 3 major asset classes, guys. There's real estate, there's business ownership, and there's paper assets, right? Real estate, business ownership, paper assets. Paper assets being stocks, bonds, and kind of stocks, bonds lead to, mutual funds, index funds, things of that nature. And what we talked about is how you can choose to be passive and you can choose to be active in any one of these 3 asset classes. Passive is where you put your money to work and you're hoping that over time, somewhere between 30 to 40 years, that you'll earn enough that the snowball will grow large enough because of compounding interest that you can create wealth. And you can, but it takes you being incredibly diligent, saving consistently, and working consistently for those 30 to 40 years, right? As opposed to using leverage and being an active investor. Active investors don't just think about capital, they think about leverage. What and where can I actually add leverage to my financial life? Okay. And so I gave you guys some examples. I talked about how in business ownership, you can build a business, that's active investing, and you can buy a business, right? Typically, when you're using active investment strategies, there are specific skill sets that you are learning that help you in this conversation, right? There's a specialty that you potentially have. Real estate, you can fix and flip property, or you can purchase property to rent and be a landlord, right? This is passive, this is active. In the paper asset world, there are 3 types of investors. There are day traders, there are swing traders, and then there are buy and hold investors. Day traders are active. Swing traders are active. Buy and hold investors, people who buy a stock or a mutual fund and they hold it for 5, 10, 15, 20 years, they're passive. So guys, you can see that in any one of these asset classes at a high level, you could choose to be passive or active. But the reality of the Wealth Op plan is we are going to show you, and I'm going to share with you guys starting right now, how you can start to transition into an active investment role without having to replace your career, without having to have another 20, 30, 40 hour a week career, but how you can start to transition into a more active investment role or use strategies that have more leverage. And where I'm going to start this conversation, guys, is where many of you are actually investing and saving now. Because for many of you guys watching this, you've chosen so far, and rightfully so, right? You've done what you were supposed to or what you knew to do. But where a lot of you guys have chosen to start investing and saving when it comes to the future is in your retirement accounts, within your investment accounts. And so in your investment accounts, guys, the idea has typically been, when you think about the strategy you were using, it's been buy and hold and long-term investing, right? What I call money management, right? Traditional money management. And one of the things that we've mentioned that I was going to share with you guys in this Wealth Op Challenge, guys, is really the truth behind your 457s and your 401ks, that for over 11 plus years, I've seen 9 out of 10 first responders do not actually know this. They don't know this about their 401ks or 457s. So one of the things that most people don't know when we talk strategy is that when it comes to your 401ks and your 457s, guys, there is a massive difference. I'm going to talk about this more, but I'm going to go back and share my screen. So I want to share with you guys that there is a major, major difference between managing money and managing risk. What if there was a way to potentially, past performance is never a guarantee of future results and returns, but guys, what if there was a strategy and a way to enhance your returns and actually end up with potentially 30 to 40% more money in your investment accounts? What if there was a way to actually enhance your returns by learning how to assess and manage risk versus managing money? Well, Ramie, what's the difference? What's the difference between managing money and managing risk? You see, in the paper asset world, the stock market, guys, most people are not, who are on this call, most first responders are not day trading, they're not swing trading, they're buy and hold investing. That's what they've been taught to do. And if you're a buy and hold investor, you get to choose between using traditional money management or using active risk management. But most first responders don't know that they actually have that choice. And so what would be the difference in applying risk management versus money management? Money management is the idea that you should just basically pick a portfolio of stocks and bonds based on your age and how long you think you're going to continue to work for and what your risk tolerance is. And no matter what happens in the stock market, when the market's going up and down, don't worry, because you're in it for the long haul. The market always comes back. Things are so cheap down here that when the market drops, you're taking advantage of dollar cost averaging, and so you should just buy some more. Those 3 lines I just gave you are the 3 lines that most traditional money managers are taught to say to people when they get concerned about losing money in their 457s. And they're taught to say that to you, not to help you with your money, but to help you with your emotions. And while that's needed, here's the reality, guys. Money management, statistically speaking, has failed to outperform the stock market, meaning traditional money managers, 97% of money managers who use traditional management don't outperform the market. And most first responders don't know that they actually have the choice to actually look at risk management. And so with traditional money management, the strategy that is being used right now on the dollars you're putting into your investment accounts is that irregardless of where the market is, whether the market's moving up, sideways, or down, or flat, irregardless of that, the only time there's going to be any active change to your investment strategy is if you call in and decide to make a change. Otherwise, based on your age and how much longer you have to go, nothing changes really until you're older and closer to whatever date you said you were going to retire. Now, here's why that's really interesting and really challenging, and why most people who are using traditional money management don't actually have more wealth than they could have had within these retirement accounts, these investment accounts. I'm going to share some stats with you guys. I know I've used a whiteboard for most of this, guys, but I'm going to actually break that pattern for a moment because I want to share some stuff with you guys that I think is incredibly important to understand in 2023, where we are right now in the cycle of the markets, where we've come from. And there's a saying that history doesn't always repeat, but history oftentimes rhymes. So I want to show you guys some history really quick. For those of you, whether you're a retired first responder or not, or you're still working, if you are a first responder, let me be clear, who has money in the stock market, you're really going to want to pay attention over the next 10 minutes of what we talk about, guys. Okay? You're going to want to pay attention here. This is critical to helping you potentially literally be able to have 30 to 40% more money in your investment accounts than you currently are set to have. And I'm going to show you those results. I'm going to share that with you. So let me go back here so I can share my screen and so that we can talk about this. Let's see. Okay. All right, guys. So now I just want you guys to look at a few things. I'm not going to go through every single one of these slides on purpose, guys. I'm not going to kind of go into a PowerPoint presentation here, but I want you to look at a few things with me. Okay, you see what you're looking at right now, there's about 3 or 4 slides that I'm going to share with you guys today. Out of all of these, there's really only 3 or 4 or 5 slides that are important. Number 1, understand that if you want to create wealth, you have to understand trends. You have to know when the waves are coming. If you can get in front of trends, there's a saying when it comes to wealth, the trend is your friend. You have to know where the trend is, where the tide is, when the tide's going out, when the tide's coming in. So if you look at the history of the stock market, guys, for all of you who are maxing out those 457, those 401ks, we have literally had 1, 2, 3, 4, 5 bull markets over the last 100+ years. 5 bull markets where the stock market was going up, and we've had 1, 2, 3, 4 bear markets where the market was literally flat, you made nothing, or you lost money. 5 bull markets, 1, 2, 3, 4 bear markets. Now, here's the interesting thing about this. When it comes to buy and hold investing has done a pretty good job in some of these cycles. As a matter of fact, let's actually give credit where it's due. If you look, we don't even have to go back to the 1800s, but if you look at the 50s, 1954 to 1966, if you just bought and held and you didn't even pay attention to your 457, your 401k, you just bought and held the index, you would have made 154% return in 11 years. Okay? But then something happened. The cycles changed. And look at what happened for 17 years after that when a bear market came. If you just bought and held, you literally didn't even make 1% over 17 years. Right? And what was going on in 1966 to 1982? We were in a high tax environment. Guys, you know that the highest federal tax you paid on your money that you could have paid, depending on your income, was upwards of 75% back then. At one point. Okay, so we had high taxes, right? They were trying to get inflation under check back then. And then we got back into a bull market in 1982 to 1999. And think about this. For those 17 years, if all you did was buy and hold, for 17 years following, you would have had a cumulative return of over about 1,000% return. But then guess what happened? 2000 came. And the 2000s, from 2000 to 2010, 11 years, if you just bought and held, you made less than 1%. And what happened in 2000, 2010, guys, there was two major market crashes. There was the dot-com crash. How many of you guys remember the dot-com boom and the dot-com crash? And then after recovering from that, there was the real estate crash, the housing crisis of 2008. Imagine being a first responder, working, saving, investing for 10 years, and you've made no progress in your investment accounts. And some people go, well, Ramie, I was still making money. But when you do the math, if you were working and saving during that time, it wasn't that you were making interest. It was that your dollars were what was being reflected as growth. It was your contribution, not interest you made, because the market was flat because of two 50% crashes. But guess what? From 2011 to 2019, the market started to rally, and we just saw this crazy bull market, up 146%. So you see, guys, just like the seasons change, cycles in the market change. Now, something interesting happened in 2013. A gentleman who's incredibly popular in the financial world, one of the leading, thought leaders in finance, was a gentleman by the name of John Bogle. John Bogle predicted, he was the gentleman who created Vanguard. Okay. So John Bogle created Vanguard. I don't know if I'm still sharing my screen. I hope I am, and I hope you guys can see this slide. But he had a statement. And his statement was that he believed that in 2013, he said this, that we should be prepared in an interview to CNBC for at least two declines of maybe 25 to 30%, maybe even 50% in the coming decade. This was in 2013. And he continued, he says, I went through one in 1973 to 1974. I went through one in 2001 and 2003, and I went through another one in 2008 to 2009. They can be scary, often terrifying, but they're typical, meaning it's just part of the seasons changing in the economy and the cycle of the market. And the challenge is most people don't know that if all you're doing is buy and hold investing, and you're going into that sideways to downward cycle, that decade of where the markets are kind of 2 steps forward, 2 steps back, you're subjecting yourself to very low to almost potentially no returns if history was to repeat. Working hard, saving, and investing to constantly see your statements yo-yo and cycle up and down and effectively almost get nowhere. And so if you even think about this, guys, for a moment, think about where the stock market's been since 2019. 2020, we had a pretty crazy crash because of the shutdowns of the economies and the health crisis by 30% in 3 weeks. Kind of recovered from that. Hit new all-time highs in the market in 2021. Then last year, 2022, the market was down 26%. So literally, John Bogle's predictions came true. He was spot on. We've already started to see the signs that the cycle might be changing, and we might now be in what we've been in before, a more bear market cycle. But guess what the secret is? This is why we said this is the truth about your 457s and your 401ks that you might not know. You can actually still thrive and do sometimes even better in a bear market than you can in a bull market. If you know how to look for opportunities when everyone else is fearful. But that's where risk management comes into play. You have to understand and have risk management. You see, the problem with the traditional thought process, the traditional thought process is the idea that you can simply just constantly wait to recover from losses. You'll make it back. You may make your money back, but you don't get the time back that you spent just getting back to where you once were. And so traditional money management, guys, is just buy and hold. It doesn't look at the market when these cycles, and there are trends and indicators that are telling you that it might not make sense to be as aggressive. It might not make sense to be this conservative. Most people say, well, Ramie, isn't it true that you can't time the market? If what you're saying is true, wouldn't everyone do it? Wouldn't every advisory firm just offer this? The answer is no. Most risk managers have account minimums of at least 1.5 million. And so for most people, if you don't have at least that, most firms that are going to do active management, they don't have time to go golf because they actually are actively managing assets, have a minimum account requirement that locks most folks in the US out of even accessing that level of portfolio management. And active risk management isn't timing. Let me ask you guys a question, and I'm going to show you the difference in results in real numbers. Imagine you're sitting in a car and you're at a stoplight and you're looking in your rearview mirror and you see a car approaching, and that car is not slowing down. And it's getting closer and closer, and you're noticing that, this car is not slowing down. Do you have a crystal ball that that car is going to hit you? The answer is no. You don't have a crystal ball that car is going to hit you. But there you are at a stoplight with a car coming 40 miles an hour. No crystal ball that it's not going to hit you. But what do you have? You have an indication based on what you're seeing and the distance that there's a high probability, I'm not certain, but I have a high probability based on what I'm seeing that this car might hit me. And so because of that indication and the probabilities of the risk of staying here and hoping this car stops, I'm going to go ahead and move out the way. In investing, you never get to work with certainties. You always work with probabilities. And risk managers, we look at indicators that tell us what is the trend, up, sideways, or down. What is the structure? Is there positive structure here? Or is there weak structure? And what is the momentum? And we let the trend, the structure, and the momentum help us look at different time frames, different sectors, and make decisions about whether or not it makes sense to have our clients exposed to stocks, or maybe it makes sense to take some chips off the table. And by applying active risk management, that doesn't guarantee you won't lose money, but what it's done over time is it's helped us help our clients make more by losing less. Not avoiding loss, but losing less. That's the aim in what risk managers do. They actually look at the trend, structure, and momentum. It's not just about, is John 54 years old or is he 34? It doesn't just have to do with your age and how much longer you think you're going to have to work. It has to do with saying, it doesn't matter what my client's age and their length of time of work is. What matters is also, where is the market in the cycles? And what is the indicators telling us about the trend, structure, and the momentum? And using that information to help enhance our clients' returns so that they have more money than they would have had, and more so that they have less risk, less instability than they would have to endure without that. That's the difference between managing money and managing risk. And what most folks don't know about these 457s and 401ks is that, let me go back here and let me share a couple things with you guys. So when you look at this, guys, that becomes important, because when you lose money, most people don't know this, but if I lose, what does it actually take to make back money once I've lost it? Well, if I lose 25% in my retirement account, it actually takes 33% just to break even. If I lose 50%, it takes 100% return to break even. So losing money hurts more than making money helps. The saving grace is the fact that you are actually contributing. If that was not the case, guys, in cycles where the market is sideways, it becomes incredibly challenging. And so active risk management looks at trend, structure, momentum. I'm going to share this with you guys by actually going to the stock market charts. We're going to actually take a live look at the market. Now, don't freak out. There's only a couple things I have left to share with you before we transition. But we're going to take a look at the market, and I'm going to show you how trend, structure, and momentum helped us help our clients over the years win more by losing less. Hopefully you guys are all still with me. Let's go here. So if I look at this, guys, right now, what am I looking at? I'm going to go ahead, and don't worry about these colors and all that stuff. I'm going to break this down for you guys. Let's look at the S&P 500, an index that tracks the 500 biggest and best companies in the United States across all different sectors. And we're going to look at a chart that shows us the month-to-month movement of the S&P 500. Okay. Now, here's something I want you guys to pay attention to. If I zoom out, I'm going to highlight this. There's only 3 points you need to look at. I'm going to highlight right here for you guys. What do you guys notice about right here? Where I just highlighted. Let's zoom in. All of a sudden, what becomes clear is that up until that point that I just highlighted, you had the market moving up. We can see that. You can see that these lines that look like a wave, they're stacked positive. The smaller ones are above the bigger ones. Bigger ones can hold more weight than the smaller ones. Pretty simple. And the momentum is pretty positive because there's more green than red. But something changes. And right here, if I was to hover over this candle, it's telling me the date was November 1st, 2007. You see, timing the market, which no one can do perfectly, knowing when's the top, what's the bottom, timing the market would have known that this is the time to get out. We didn't do that. We waited until we saw alignment across all three. The trend broke, the structure changed, and the momentum of sellers picked up. And we got out right here, January 2008, not November 2007. And while we didn't time the market perfectly, what that helped us do using trend structure momentum is avoid a 47% crash of what was a 52% loss in value for investors. That is the difference between managing money, managing risk. Managing money would have said, well, it doesn't matter because Mike's still in his 30s. So he can just buy more shares now that they're cheaper. Yeah, but he could do that. He can also do that. But instead of just doing that, Mike doesn't have to wait till the market gets back to where it once was to break even. Mike can actually become more profitable quicker because of actively managing risk versus managing money. That is the difference, guys. And if we fast forward and we look at this, we could see that massive bull market that we saw in that chart from 2009 all the way to 2019. But notice something happened last year. Last year, all of a sudden, for the first time since 2009, we saw the same story start to unfold. And again, by looking at the trend, the structure, and the momentum, we were able to actually be proactive in helping our clients get ahead of what became a pretty big correction. And so now, all of a sudden, when you have those two forces at work, active risk management, then you can have better results. And when I say better results, let's actually go look at some things and see what active risk management led to as it relates to returns. Knowing again, right, it's no guarantee of what the future holds, but if I'm going to be investing to create wealth, I want to know that there's active strategies that are helping me protect my wealth and enhance it. So I actually have an example for you guys of what actually happened. I'll wait till this loads here, guys, but on the right is an example of a client who had $100,000, John, age 52, and he was using traditional buy and hold diversification and just dollar cost averaging. And that $100,000, okay, if you just left it, didn't add any money in this example, just let $100,000 go through the markets, it would have turned into $717,000 by the end of 2022. Jane, who had active risk management, same 100,000, except we were actually looking at trend structure momentum. Instead of having $717,000, ended up with $1.1 million. Over $400,000 more, not because she picked better stocks, not because she had some edge in picking better companies, simply because of active risk management. And when it comes to your 457s, your 401ks, guys, one of the things that you can actually do is you can actually contact the administrators to find out if you are eligible for something called an SDBA, self-directed brokerage account. It's also sometimes referred to as a PCRA, or personal choice retirement account. That's the first question. Because what that means is that you have the ability to open an account that doesn't disrupt or impact contributions, employer matches, but it allows you to have an account that you can actually now access risk management. And the second question that you can ask is, am I eligible for third-party management? Can I actually hire my own advisors or risk managers to manage the account through my SDBA, through the employer, without penalties or anything or taxes? And if those two things are yes, then guess what? You all these years could have accessed risk management and had the power of active risk management at work for you. And all of a sudden, you have the ability to actually be more in control, more empowered to take action and to understand what phase of a cycle we're in and to potentially enhance your returns. And what that leads to all of a sudden is putting yourself in a better position, guys, to enhance your wealth during the time you're working while learning and doing some of the additional things we're going to be teaching you. So I wanted you guys to know that, because I literally have seen first responder after first responder after first responder sit down and concerned about, man, I wish I had more. I feel like I should have more. I'm maxing these things out. I kind of am just not really paying attention. I don't really open my statements. Most first responders do not even look at their statements because they don't really know what they're looking at. And so for you guys, I would implore, it's my belief, and I would suggest that if you're going to be in the market, and obviously you're not going to become a day trader, you're not going to become a swing trader, then I would suggest that you might want to start to learn or have people that know how to manage risk versus just traditionally having people that manage money, because that can lead to potentially more wealth. And as you're starting to make the shift from active to passive, that becomes incredibly important. So here's what we're going to do, guys. Okay, a couple things. Number one, there's going to be a link that gets dropped as it relates to your in the comments in the group. There's also, it's going to go out with the replay of the email. That link is a link that you can fill out. If you're part of the Wealth Op Challenge, we're going to do this time. It might not be something we're going to be able to do in every challenge moving forward, guys. But for anyone who's watching this version of the Wealth Op Challenge, you can use that link to fill out a form. That form, that intake form, is going to go directly to my office, and myself, my team of advisors are going to be able to help you learn, make a call to your company to actually ask these questions to see if you actually have the eligibility to do this. And if so, help you set that up. And so I think Holli just provided that link there. So if you want to actually implement active risk management, if you want to explore leveraging active risk management, especially right now where the stock market is today, and not just kind of cross your fingers and buy and hold, hit the link, fill out the form. The form asks some detailed questions, guys. It doesn't ask about account statements or specific account numbers, but it does ask income and where are you saving and investing as it relates to your risk, your portfolios. Fill this out to your best of your ability, and it's going to be either myself and my team that gets back to you here, and we'll help you implement risk management. We'll teach you what the difference is between what you're doing and risk management. What is the cost? What are the difference between what you're paying now? Most people don't even know what fees they are paying on the money that they're dependent on. Think about this. Imagine going to a grocery store and just putting groceries in, not looking at the price. Imagine going to purchase a vehicle, or a home, and just writing a blank check and saying, hey, here's a blank check. Whatever you guys say it costs is what I'll pay. Nowhere do people behave that way, but when it comes to their money, their wealth, they'll hand it over to a Wall Street-based firm, and they won't even ask what the costs are. They don't even know how to assess what they're actually paying in fees. So if you want to actually learn and implement risk management so that as we transition now, okay, as we transition, guys, into some of these more active strategies, this is one of them. This is one of them, but it isn't the only one you're about to learn about this week. We're getting into the strategy part now. We've laid the foundation. But as you move from a passive investor who is solely dependent on the pension and the 457, 401k combination to, hey, I'm going to let this work for me. I'm going to let this continue to work for me. I'm not going to stop what I'm doing, but I'm going to enhance the wealth I can create by moving from passive to active strategies.
Hey, Ram, I got a question for you from the comments if you got a second.
Yeah, absolutely.
So one of the questions is, hey, I signed up when I started in my department and they had me select a target retirement fund. Does that mean I'm an active investor or a passive investor? And how do I fix it?
Yeah, that's an example of being a passive investor. That target fund, the definition of that target fund is, what is it targeting? It's targeting a date in the future that you told the fund. So it means, hey, what we're going to do is imagine you chose the 2035 fund. What you just told that mutual fund, that index fund, is I'm here today. 2035 is when I think I'm going to retire. And so the fund is just going to automatically rebalance from stocks to a more conservative position the closer you get to that target date. That is passive investing. That means there's not any rebalancing actually based on market factors. Think about this. There is no rebalancing based on market factors as much as it is based on what year you are in. Guys, in 2023, you can do much better than this. But guess what? The finding is reserved for the searchers. There are millions of first responders in the United States. There are not millions of first responders on this challenge, which we hope to change. But guess what? This is the first one. You guys are part of the first class. So a target fund is a passive investment strategy, guys. It is not active. Not by the definition of active I've given you guys and what I've shared. So do not, guys, the information that you do not implement, and the information that you do not know how to implement cannot help you. And I'm going to share with you guys, we're going to share with you guys, like, hey, you can call by yourself. You can do it yourself. You can contact your department. Am I eligible for an SDBA or a PCRA? Make sure that whoever's answering you, make sure they actually know what they're talking about, guys. There's a lot of times where most of the customer service is not familiar because they're not used to having people ask about this. So ask if they can confirm that they are actually, completely solid and that they are 100% capable of answering whether or not it's a yes or no. And if it is, then that's something you can set up. You can ask them, it gets set up. You can log on like you do now. You can direct funds there, and you can choose more investment options, one of them being risk management. If you want our help with it, then fill out that link, guys, so that we can do it with you. We can show you the right way to go about it and make sure that you're set up correctly. Tomorrow, that was your first version. That was the first version of this conversation Holly mentioned about good, better, and best. What's good? What's good is investing for the future. Because what's not good is doing nothing. So what's good is investing for the future. What's better is understanding how you can start to use active investment strategies, and you can kind of try to do it yourself. And the best is active risk management. Coupled with the right income plan. Tomorrow, you're going to see something that I think is probably going to shock you guys. As we start to move from passive to active, and we shift into one of the most effective ways to start to generate cash flow from assets, and look at what asset between real estate, business ownership, and the stock market can do that. And we're going to share with you guys a strategy Mike and Hall have been using to build some incredible wealth, guys, while they're serving their community, while he's serving the community as a first responder. So make sure to show up tomorrow as we go through that, because you're going to learn about this, and we're going to invite you guys to learn how to be able to implement that more with us from tomorrow on. So with that, guys, I'm going to turn it back to Mike and Hall. I'm looking forward, guys. We're now getting into the strategy. I know today was not as much foundation as it was being more strategic about the market and active management, but it's incredibly important because the results speak for themselves. And while we know, again, there's no certainty that something's going to happen in the future, we can let history rhyming mean that we're very confident and have high probabilities that we're going to continue to be able to outperform the market by being more effective in risk management. So I'm looking forward to seeing you guys tomorrow as we get into the good, better, and best of cash flow now with some strategies Mike and Hall are going to talk about with me that they're using today. So Hall, Mike, I'm going to turn it back over to you guys.
Thank you, Ram. Very, very much appreciate it. Hey, guys, as you're going through this and you're like, okay, this is a stock option strategy, this is my retirement account, just remember this is part of the wealth op that we're putting together. This is just one of the many pieces, but it's an absolute critical piece because if you do this right, it actually gives you the ability to move some of these assets into other wealth producing vehicles. So like Ramie mentioned, day 4, the ultimate path to your retirement, 10 years and less. So we're going to find, identify, and evaluate lucrative investment facilities and options. That's going to be a lot of fun. Funding options, pitfalls to avoid. We're going to learn how to build equity through increasing revenue and decreasing costs. This is talking about some of the real estate game. And actually, some of you who are on this call, we've had pretty in-depth conversations about real estate, the right type of real estate, what is the most not only liability proof, but what can create the most revenues, best margins, best tax strategies. There are good real estate games and there's really good real estate games. And I'd rather be on the really good side, especially when it comes to taxes. We're going to talk about how you can actually do this, talk about cost segregation studies, and understand how to actually build out a foundation where you can purchase real estate and use that to build wealth on top of the other options like your deferred comp and your pension. So if we look at this right, we're going to have multiple vehicles all heading in the same direction, and how we leverage those together is how we really create wealth. So if you are on this watching the replay or you're watching it live, come tomorrow, please. You're going to get that notebook that Holli mentioned. Take notes. There's a few things you can scan in there. If you want to, or if you have time today, I would highly suggest going back to day 2, clicking on that barcode, figure out your number. And then like Ramie mentioned, he can help you with your investment planning. If you are on this and you're from my department, the answer to those 2 questions were yes and yes. You do have the ability to have somebody else manage your account. If that's not Ramie, find somebody. We just implore you to start getting in the game of active risk management and not just letting your retirement be a passive thing you don't think about daily. So if you want to meet with him, there is a link I believe Holli put up earlier. There it is, Risk Management Consult. So click on that. He can help you work through it. He handles all of our accounts. It's been an absolute game changer for us. And then, like I said earlier, share this link. If there's somebody at your department or a family member that's in the first responder industry, share this information. We're just trying to get the message out. We're trying to actually restore families and bring the wealth back to this industry so people can show up better at home and show up better at work. Share the link if there's anybody else who you think may benefit from this. Send it off to them. This is all free. We're just trying to spread this information throughout our industry. So we are excited about day 4. Please show up ready to go. Grab that workbook. We'll throw it in Facebook, and then the replay email, I believe we're going to have a link to that as well. Bring it with you, print it out, or you can leave it at PDF on your computer. But taking notes is critical, and then we can go back through those notes to make sure that we're actually implementing and taking action. So tomorrow it's going to be noon Pacific time. It's either going to be on Facebook Live or on YouTube. And then you can watch the replays. It'll be in your email. So we will see you tomorrow, day 4 at noon Pacific time. See you then.